Good afternoon, friends. In continuation with my last video on diversification, I thought of talking today and sharing with you whatever little knowledge I have in the area of stock diversification. As we noticed last time, diversification against asset class is very, very important. That really helps you to spread the risk against different asset class. Coming back to stock diversification, the principle says that if you are investing in stock, then how many stock you should have? Should you have 1 stock, 2 stock, 10 stock, 20 stock, or 50 stocks? There is no one answer for this question. The book talks about holding 8 to 10 stocks or 8 to 15 stocks for sufficient diversification. This could be diversification against different industries. You may like to pick up some stocks from different industries and then focus on that. And lower the number of stocks, better you will have control. And very interestingly, when you look at the legend investor Warren Buffett, his thinking on diversification is completely different. He believed that if you can analyze one industry and if you know this business is doing good, better stay with one business. But mind it, all of us are not Warren Buffett. We don't have neither that skill, nor that liberty of time to really read a lot and have contact with the companies, etc. Even the mutual funds manager, you look at their portfolio, they have a very large number of stocks in the portfolio. So I suspect very rarely people will go to the level of Warren Buffett. So in case if you are not Warren Buffett, then what do you do? Should you in that case go with 5-10 stocks or just remain invested in too many stocks in the portfolio? My personal take is, if you can spend some time in terms of analyzing data, or if you can look at data, historical returns from different companies, and you have generally good idea how the company is doing, in that case, I think you should restrict to 10 to 15 stocks maximum. In fact, if you know that a particular company is doing too good, better to stay with that company and allocate a large portion of your fund in that company. When I say large portion, I will not suggest to invest 40% or 50% of your value in a single stock. Instead, what I meant here was maybe 10 to 20% max. So this means your top 10 stocks should have, let's say, around 70-80% of your investment, and top 5 stock could be in the range of 50 to 60%. If you look at the portfolio of Warren Buffett, top 10 stock in his portfolio amounts for around 87% of the total investment, and top 5% stocks amount for around 67% of total investment. So that's very clear. This means, the industry sector or your confidence in a particular enterprise is very high, then go long on that particular sector. So this means in your portfolio, if you can pick up 5 companies and let us say in each one of them you invest around 12-13%, or could be even varying degree in those companies, and then balance it out with others with lower percentages, that could be reasonably good diversification. Before I end this video, I like to quote another very famous saying from Warren Buffett. What he opined was, diversification is nothing but it's a protection against your ignorance. And maybe he's right, because we are not well informed investor. And therefore, in order to protect your stuff, we have partial knowledge, we carry some knowledge, and therefore we may take approach of middle road. Other things could be done. One can invest in few sectors or few enterprise actively. This means, you are monitoring, so maybe 60 or 70% of your investment could be active investment, where you restrict number of stocks and which you monitor, which you study, follow their quarterly reviews, their quarterly presentation, industry trend, etc., analyze their balance sheet. If that is too difficult, then you could really balance between active and passive investment. The best way of doing passive investment could be investing into the index fund, because we have to also keep your expenses low. So if you invest in mutual fund, the money you are paying to fund manager is pretty high, because even in direct scheme you end up paying around 1.25%, irrespective of if your portfolio earns or it doesn't earn. Whereas passive investment could be in form of index fund, where the expenses are very, very low. It could be in the range of 0.2 to 0.3% max. So that makes sense. So if you are 100% passive, maybe large portion of your fund put in the index fund, but you think you are 50-50, I would suggest in that case, put 60% in active investment and follow a few stocks, and 40% as passive, where you follow certain index fund. That will give you pretty good result. And I think diversification is more of a personal choice. If you read the industry literature, people have different opinions. So I think you should define your own way of diversification and decide the policy of investment and accordingly get going. If you like this video, do not forget to subscribe it and put your views on diversification. We are aiming to create a platform where we can share views of each other. So please do that. And before I end the video, any investment in stock is a risky affair. So therefore, before investing, either study it or take help of your financial advisor. Thank you so much for being with me and have a great day.